IRS came out with a new revenue ruling at the beginning of this year that's really flown under the radar, and it could mean big tax increases on inheritance for your kids. I've got that and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button when you are saving up for your future. And for most people, that's retirement, or if you're just building wealth, we're going to encourage you to have a tax shelter strategy. And most people think, well, you don't need a strategy. I'm going to save in my 401k. Now, is it 401k plus Roth IRA? Is it Roth 401k and then backdoor Roth? Or what's your tax shelter strategy? Now, some people, they fill up those buckets, they contribute as much as they possibly can, and then they have some leftover, or some people just ignore that tax shelter strategy anyway and just throw some money in a Robinhood account or an investment account and trade meme stocks and all that sort of stuff. If you are only saving up into 401ks, Roth IRAs, those tax shelters, you're going to list beneficiaries to those so that when you pass away, those accounts will pass on to your primary beneficiary, typically your spouse if you're married, and you're going to list contingent beneficiaries, or if you're not married, you're going to list kids there, and it will pass along to the kids. The IRS has changed these rules, or Congress has changed those rules, and your kids will have 10 years over which they've got to withdraw money and then completely empty that account. They've got 10 years. It's a new 10-year rule for these tax sheltered accounts, 401ks, IRAs, Roth IRAs, those sorts of things. But for the investments outside of those tax shelters, because you sold a property, maybe you sold your house and are now renting, or maybe later in life, assisted living, that sort of thing. Maybe you owned a business, or maybe you were just you'd already funded all your tax shelters and you were just funding an extra joint account, something like that. For all those other dollars, well, how will they pass along to the next generation? Well, hopefully you're adding a beneficiary to those or putting them in a trust so that they avoid probate. But from a tax standpoint, there's something called a step up in cost basis at death rule. And what that means is, take for a simple example, outside in a non-IRA, non-Roth IRA account, you've just got an individual account or joint account. You've been investing in Apple stock for the past decade or so. And so the amount of money that you've invested into Apple stock is this. And at the time you pass away, you never sold this Apple stock. At the time you pass away, that Apple stock is worth this. So you've got a lot of capital gain or appreciation that if you sold that Apple stock, all of that capital gain would be realized capital gain on your taxes, and you'd need to pay tax on it. But because you never sold it and you still held that at your death, basically the question, will your heirs, those who inherit the money, will they have to pay tax on that difference? No, there's a step up in cost basis. And therefore, if your heirs say, well, we don't need the Apple stock, we don't want the Apple stock, we need the cash, and therefore, thank you very much for that unbelievable inheritance, that gift. We're going to sell it. We're going to sell it up here. Even though you paid or you invested this much, we're going to sell it up here. And they won't have to pay any tax because there's a step up in cost basis as of the date of death. This rule has been very helpful to families along the way. And because of this, many people have planned around this and planned for this in the situations where it's applicable. Well, very quietly, flown under the radar, the IRS issued a revenue ruling, meaning a new law, a new interpretation of the laws, in March of this year, Revenue Ruling 2023-2, and that states essentially property like your house or stocks or other real estate that is not included in your estate will no longer receive a step up in cost basis. That might sound a little interesting, but when you own investments and all that sort of stuff and you pass away, all of those investments should be included in your estate and are then passed down to the next generation. Well, if that happens, the IRS says, fine, no problem. all of those assets will get a step up in cost basis if applicable, and then, things will carry on as normal. Well, what about assets that don't pass through your estate? So assets that possibly avoid probate or aren't included in your estate. And one such asset that, or structure of an asset that could be sort of the target of this new revenue ruling are irrevocable trusts. Now let me set the stage here and I'll simplify it, and there's no way to get into all the details here. The point is, this is changing. It might influence how you plan. It might influence your taxes. Work with your certified financial planner. I mean, that's the action item. But let me just set the stage. If you have a lot of assets that are outside of IRAs, 401ks, those sorts of things, and you want to have some sort of influence as to when they're distributed to the next generation, and you want to shelter them from probate, you might put them in a revocable living trust. And revocable means you're still alive, you can change it at any time. It's no big deal. It's held in trust, so it has these extra provisions and so on. But there's really no real difference between you and this trust, because while you're living, you can make any change you want, okay? That's not what we're talking about. A different type of trust is irrevocable or irrevocable. Same thing, tomato, tomato. And that means when you put money into this irrevocable trust, you can't change it. You can't make any changes. It's irrevocable, and therefore no change. It's locked down. There's a trustee that has to manage those dollars based on those trust provisions, but it's sort of locked in there. People will do this irrevocable trust, if they have certain planning goals. And one of them could be, well, we want to protect some assets from the risk of going into a nursing home, and we want to make ourselves more eligible for Medicaid. Well, that's a risky one, because once you put the money into this irrevocable trust, you can't get it back. There's other reasons to do an irrevocable trust. Say a new marriage late in life, where mom and dad raised the kids and they accumulated a lot of money, and then one of them becomes a widow, and after a little bit of time they remarry. It's very typical that assets accumulated early on during that first marriage are put into an irrevocable trust so that they're sort of protected for the kids. And so there are other reasons to have an irrevocable trust as well. If you're not careful, or some irrevocable trusts are written such that they're not included in your estate. They're not included in your estate. And if they're not included in your estate, based on this new revenue ruling, they will no longer have a step up in cost basis. This could be thousands of dollars. This could be a significant tax increase to you and your heirs. So what's the point? Does this mean never use an irrevocable trust? Well, I would always caution someone from doing that, because it's irrevocable. You can't undo it. However, there are times when you're going to want to use it, or it may make sense. There is a way to draft an irrevocable trust to still have those dollars included in your estate, if that is the best idea. So therefore, you could get around this new revenue ruling. If you're doing advanced estate planning, you might say, no, I'm okay with these dollars not being in my estate because they're going to avoid federal estate tax, and I'm okay. I'm aware now that they won't get a step up in cost basis. It seems like this new revenue ruling, the IRS is taking direct aim at that federal estate tax, which is currently that exemption is millions, almost $13 million. It seems as though the IRS is getting ready for that to come down, which is currently scheduled to do if there aren't any changes. So looks like they're taking direct aim at that. If you are subject or may be subject to federal estate tax, work with your certified financial planner, be aware of this new revenue ruling, and be aware of the planning implications so that you can plan around it. Work with your certified financial planner on that. If you don't have a CFP on your team, contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go on and take your next wise step in your financial life.